When the global headwinds became stronger and foreign investors started losing faith in Indian equity markets, it's the domestic investors who filled the void. Their belief in India's growth story and its strong economic fundamentals appeared unshakable. A research report by Morgan Stanley says that since 2015, the holdings of foreign portfolio investors in a sample of 75 Indian companies have declined about 230 basis points to 24.8%, while domestic mutual funds have increased their stake by 580 bps to 9.5%, and individual investors by 157 bps to 9% in the same period. The FPI selling has been brutal since October last year. During the 9-month period since October, the investors net sold equities worth 2.56 trillion rupees owing to a series of factors including geopolitical uncertainties and tightening monetary policy across central banks. In the June month alone, FPIs pulled out over 50,000 crore rupees, making it the worst sell-off in nearly 2 years. However, the tide turned in July as foreign investors turned net buyers, investing 5,000 crore rupees in Indian markets. But the FPI selling in the recent past cannot be the only reason why domestic investors came out on top. Let us take a larger sample, that of 1,770 NSE-listed companies for which the shareholding patterns are available. So, in these companies, the share of domestic institutional investors, along with retail and high net worth individual investors, in the NSE-listed companies reached an all-time high of 23.53% as of June end, according to data from Prime Infobase. Domestic investors include domestic institutions such as mutual funds, insurance companies, and pension funds, etc. The share of mutual fund holdings in Indian companies climbed to 7.75% in FY22 from 4.99% in FY17, while that of insurance companies and institutional investor LIC has declined during the same period.
One big underlying trend is that Indians or domestic investors have been underinvested in Indian equities since for long, right? And even after these flows that we are seeing, they are still underinvested in equity. So this trend will continue as far as domestic inflows are concerned. Look, Indian markets are still really illiquid. If you go beyond top 100 companies, it is very difficult for an institutional investor to make a meaningful position. Some of the larger investors, and we also from on our offshore side face that problem, right? So clearly this trend of more liquidity and a counter force really helps the market evolve and make investors less nervous. So I can assure you that if the domestic flows wouldn't have been that strong in last maybe 7-8 months, markets would have really tanked really badly, and they would have impacted capital raising capabilities of a lot of companies, including banks. That could have an impact on a lot of sectors who are kind of capital starved or who are looking for capital quite regularly, like banks and others. So this counteracting force will actually help the economy. So these forces, I think, will make the markets more active, more liquid, and more evolved is our sense.
The massive inflow of retail investors into the equity markets via Systematic Investment Plan or SIP and other routes has also contributed to the rise of domestic investments. According to the data available, there are about 55.5 million mutual fund SIP accounts through which investors regularly invest. Since FY17, SIP contributions have nearly tripled to 1.24 trillion rupees as of FY22. The SIP's assets under management climbed to 5.76 lakh crore rupees at the end of FY22, growing over 30% annually in the last 5 years, according to data from Association of Mutual Funds in India. Retail investors' total ownership in stocks climbed to 7.42% at the end of FY22 from 6.79% in FY17. In addition, India's pension fund EPF investments since 2015 in equities have ensured steady inflows into the markets. The EPFO has invested around 1.23 trillion rupees in exchange-traded funds as of FY21. It has also invested in a pool of public sector companies over the years. So will this trend sustain? And is it a good sign that markets are not too dependent on foreign investors who were once touted to be the price setters? Given their growing clout, Morgan Stanley has even handed over the tag of domestic investors.
No, I think it's a good development from the perspective that the risk capital would be available a little more locally as well. See, at the end of the day, for growing, you require both the risk capital as well as the debt capital. So while the access to the bank loan market has been decent, I think it's good to see the equity market also seeing increasing participation. So when it comes to the institutional participation, it is coming from the pension funds, provident fund organizations and all. That is a rising pool of savings every year. And they are setting aside a certain portion of their investment into equity. So this trend will only grow as far as the institutional participation is concerned. Similarly, the pool of savings in the life insurance sector, which again, some part of that finds way into the equity market, that continues to grow. What I can say is that the domestic investors is a lot more consistent secular trend.
Experts say that FII's shareholding in Indian companies will rise over a period of time, given their relative underallocation to India. At the same time, domestic investors' shareholding will continue to remain strong, and it all bodes well for the market.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
यार मत पूछ यार, फिर से स्टॉक्स में फंस गया। तो स्टॉक्स के साथ बॉन्ड्स, इंश्योरेंस, गोल्ड में बैलेंस कर। इसमें बहुत तामझाम है। तुझे 5 पैसा नहीं पता?
अब तो सबको पता है। 5 पैसा है ऑल इन वन अकाउंट। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है। Investing made easy and rewarding with 5 Paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.